The Hedgeless Horseman here. It's February the 10th, 2026. Technically, right now is or I think it's the 9th in North America. Anyway, first of all, thanks to the sponsors. There's no super relevant topic for this video except that I think, and I've said this before, and I'm kind of happy to say that that's still the case, which is that I think, some of these high quality juniors, developers, even, smaller producers, etc., they're basically as cheap as if this was like the bottom of a bear market or around the bottom of a bear market. It's kind of crazy. I discussed this on K Report today. I don't know when it's going to be uploaded, but if you are indeed a value investor and the reason to sell that you have is that you own something that's either fair valued, overvalued, or you find something even cheaper. That's it. Not trying to predict the gold price per se, not trying to predict much except for what you think the company might be worth, what it could be worth in the future, and what you're actually paying for it now. That's simple. But what have we seen? We've seen, let's look at GDXJ, for example. Versus GDX. Okay, well, whatever. This is a fat rally. This is obviously an incredible rally. Absolutely incredible. The fattest rally since this index started in 2006. So it's like, okay, this is obviously the best rally in 20 years. And what usually happens after you have almost a hockey stick graph like this, when you space it out to days, it's not as like simply vertical. It's not like it's three daily candles, and it's up here, but it's high. And of course, most people have not really seen anything like this before. And the previous rallies were kind of short-lived. Up quickly, but then they topped and we entered, a 3-year bear market. But the thing is, in 2016, gold just hit 1355 or something. Silver hit, I don't remember, maybe 27, 32, whatever it might be. But the juniors were absolutely ripping and tearing. This was one of the most epic rallies, even though it doesn't look like much compared to this. This is obviously the GDX. But my junior portfolio from bottom to top here, I think went up 500%. The entire portfolio. And I was in a lot of crap. I was in a lot of beta, optionality plays, yada, 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 buying ounces in the ground, which everybody said were really cheap. Some of the stuff that went up 600-700% actually went bankrupt later on, like Great Panther Silver, which was one of my biggest earners during this period. That is the only stock until this day that I pretty much sold the last shares of at the literal top tick. So I've never, and again, not the whole position, just the last shares I had left. I remember vividly that during the top there were days where it was like, okay, it's up 10%, and the next day up 8%, and the next day up 10%. After already being up a lot. So it was like, it felt like printing money in a sense, and the hype was for sure on in the sector. Producers were starting to price in higher silver prices than spot. So they were trading with a speculative premium, meaning that in order kind of to have this actually look cheap, silver will need to hit $40 or something, or about $35 at least. But silver was not even at 35 if I remember correctly. So that's like, okay, well, that's more of a, sentiment top that stuff was actually trading at a premium to the spot metal prices. It was pricing in that this is still going to get better. The weather tomorrow is going to be better than the weather today, and I'm happy to pay up for it. And of course, most people are not even investors. They just see the trend and they're like, whoa, it goes up, so buy in. Well, they got kicked in the teeth, and then it happened 2020, and then they got kicked. Well, everyone got kicked in the teeth, and now we have this. Obviously, everybody's going to be remembering, 2011 top who were around here. I wasn't around here. Or the 2007 top, 2016 top. I mean, the point is that a lot of people that have been around in the sector since, over the last 20 years, they know very well what usually happens after a rally. And now we've had the fattest rally, especially in the seniors ever. And I personally think we're climbing a wall of worry in a sense, because the juniors are nowhere pricing in speculative premiums. That's the point. Let's say back here, during the bottom, let's say you had juniors with a solid gold project. Let's say the NPV was like $200. Probably it was actually negative down here, but let's say that it was $200, $200 million NPV, and they were selling for 50 million. So they're undervalued on paper, but the IRRs on those projects would be like, I don't know, 10%, and maybe the capex was still like 300 million and a 200 million NPV, capex higher than NPV. So even if they were cheap on papers, like if gold prices fell by 100, maybe the NPV would be zero. So there's no margin really to talk about. That is why the IRR would be so low. So it's like, yes, on paper they were cheap, not much margin of safety. Most projects would still not make sense. I mean, you're not typically, a lot of people are going to fork up 300 million to have a $200 million NPV go into production. What you had in your favor back then was, of course, that gold was down 45%, and obviously, this is a cyclical sector. Most of the time, I don't think gold really goes down more than 50% in a bear market. I think 2000 or 1980 to 2000 was maybe actually minus 70%, which obviously was one for the ages. That was a fat bear market. But you had an idea, or it's like, we're closer to the end, we're closer to a new bull, then obviously a new bear. For each and every day that a bear trend has not bottomed yet, it's one day closer to the bull, right? We don't know much. If this wasn't the bottom, then the next day we know that we're at least one day closer to the eventual bottom. So the reason for buying goes up, etc., etc. But my point is that it was more of a contrarian trade, where it's like, on paper not that much made sense. Only the really good projects actually showed, I think, positive NPVs at whatever the gold price was here, like 1150 or 1050 or something like that. So you were kind of betting that the metal prices are going to go higher, and all of a sudden these projects are going to be worth something. You knew you were buying low, but they weren't necessarily cheap on paper. And now we have the almost complete opposite, where the gold price has gone absolutely bonkers, and especially the junior stocks haven't even caught up with this trade. A bunch of juniors, I think, are even trading at below their 2020 highs, when gold was 2,000, not 5,000. Sure, there's dilution and all of that. So you see charts out there by some people floating around on Twitter where it's like, look what it did, where this junior was trading in 2020. That's where it's gonna go. It might go that high, but sometimes the dilution is very, very heavy, and sometimes it's almost like even if now I don't have a junior in front of me with that chart, but let's say said junior was trading here, and now with gold at 5,000, it's trading down here, whatever. But sometimes the market cap is even similar because of all the dilution, etc. Still, I mean, even if you just took the same sentiment environment back in 2020, the highs, yes, the junior might actually be up here given that gold is so much higher. So there's a merit to that, and I've seen a lot of people who are most people are traders and all that, and a lot of people wants to get paid. They want to have paper profits, and they're very frustrated by the fact that gold and silver has done so well, but gold juniors and silver juniors, relatively speaking, you would think that they would be 200-300% higher by now already. Uh, so that frustrates a lot of people. I mean, especially for a trading perspective, it's like the idea is for a lot of people, it's like I just want to be part of these fat rallies, and then I'm going to sell out and find something else to have a fat rally, yada yada. I don't really mind it too much because it makes my life easy knowing that gold is at 5,000, silver is at whatever it is, 85, and the juniors are pricing in maybe $2,500 gold and $40-50 silver. That's a huge margin of safety. I don't need to worry about selling anytime soon. And it's just that's what struck me today. It's like I am so extremely bored right now, especially since the bulk of the hodl folios and my personal portfolios, I would say, are in de-risked juniors. Juniors with proven success, juniors typically with economic studies or advanced projects where you can literally read according to the economic studies that hey, these are worth 5 times the current market cap at the current spot metal prices. So it's right there. And sure, the economic studies might be off a bit, and especially if it's a PA, it might be too optimistic. But it's like if you find a solid project with third-party validation and smart money, whatever, and the economic study says, well, this is worth 4 or 5 times what the market cap is. It's not going to get any easier than that. I have never seen anything like that before. And then especially when you account for, okay, not only is it 4 or 5 times undervalued perhaps according to spot metal prices, but the IRRs are absolutely insane, and the payback periods are like a year or less. And the margin of safety before these projects, if they operate somewhat in accordance to the economic studies, is like gold could drop to, I don't know, $1,500 before you start to fear of bankruptcy, where there will be operating losses, etc. It's absolutely crazy. Or whatever, take 2,000. We're very far away from that. So they are obviously cheap on paper. They have high margin of safety. If you get one of these projects up and running, and it kind of the team executes, and it's somewhat in the ballpark of an economic study, it may pay off the initial capital in 1 year, and then you're free rolling for the rest of the mine life, and anything else the company might do with the cash flow, grow and maybe acquire and stuff. So, as always, I have no idea where gold and silver is going. I just know that this is still probably the cheapest environment with the biggest margin of safety in a lot of juniors, especially. The large companies have obviously done better. They're not, Barrick's market cap is, I don't know, 130 billion or 140. I doubt the NPV of those, their mines is like 300 billion or 400 billion. They have done well because institutional money has gone into them, U.S. money has gone into them, yada yada. But for some reason, I've talked to some who work in the PRI or part of this business, where it's like, yeah, they think Canada is pretty dead still, and that's why you see a lot of U.S. listings and a listing in Frankfurt and Europe, and okay, it makes sense. Obviously, that's going to frustrate a lot of people who wants to see the get paid now on their Canadian listed stocks. But again, as a value investor, it's a very easy life. I mean, if nobody gives a shit in Canada, so they're not getting bid up to the market is not efficient. It just I mean it's great. I mean a lot of the hodl folios are at all-time highs or 10% from them or something, and you're sitting there owning stuff that it's basically as cheap as before the sector typically goes up to 300%. Caveat being, yes, we've had the gold price has run, the big gold miners have run, and it's like, okay, well, if it's run like this, maybe we're getting close to some kind of top. It's like, who knows? I thought we were gonna have a top, more of a breather than this. But it just kept going, and now it's even in the case where it's like, hey, even if gold goes down to $3,000, I didn't overpay because I paid like these companies, we're gonna live in only a gold price environment of $2,500, and then you get all the optionality for free and all the management alpha for free and exploration and maybe preferred projects and stuff. So it's just boringly easy to find something that's on obvious buy. There's no thrill really. It's so hard to overpay for something right now that has quality that it's literally not funny. And of course, I went over this on K Report. The beauty of this is that I think we're stuck, and we were kind of stuck since 2023. I think that's when I started talking about it, at least, where it's like we're past the point of selling because stuff was so cheap. We knew we were close to some kind of bottom. Yes, it bottomed in 2024, but it's like, oh, okay, so what? The sector went down 20-30% more and then went up 300%. I mean, that's close enough, as I've talked about a bunch of times. I mean, it's like now, for example, every single buy in every single buy in this box is in the green. So how much I mean, if you bought here or there or there or there, didn't even matter. Here, there, whatever, you were green, sooner or later. If you just average down over this entire period, which was like 2013 to 15, I mean, on average, you would be absolutely in the green here. And then did the same here, you would be fat in the green here. Did the same here, fat in the green there. It's a cyclical sector. And as always, and I documented that at the time, people were thinking that this time is different. The juniors are never going to go up again because there's crypto around, there's a weed around, there's whatever excuse people give themselves to sell cheap and make the pain stop because they're seeing other sectors make money. And of course, some rotated over and sold the juniors around the lows, bought whatever hot sector, maybe crypto, maybe weed, and look what happened since then. I mean, gold has outperformed Bitcoin, and the juniors have for sure outperformed the entire crypto sector, basically. It's like everybody's chasing these perfect trades. It's like, oh yeah, I'm gonna be in the mining sector when it does like this, and then I'm gonna get into the whatever sector, because I'm gonna be guessing when this is gonna go into a bear market, and then I'm gonna be part of this curve in another sector, and then a year from now it's the same thing. So it's like everybody's kind of operating like they expect to get 500% returns per year for all eternity, even though that's like no investor in the history of the world who has done that. But hey, I mean, most of the people who do that, they lose money, and that's why, because they're obviously way too greedy. It's like my long-term goal, at least for the foreseeable future, still is to be able to compound at around 50% per year. And it gets harder, obviously, the more you have to compound. You can't be in super liquid juniors with any serious position, etc. Yes, so it's gonna get harder, but hey, I'm gonna try my best as long as I can. And sometimes you might have a whatever flat year and then up 200%, and maybe the next year you're down 50%, and then next year you're up 300%. You never know how it actually is gonna play out, because as we can see, this sector is absolutely insanely volatile. Uh, but yeah, I mean, and for people, that's why I keep posting this stuff. I mean, this is if you were able to find just probable doublers over a 2-year period on a rolling basis, where it's like, okay, I think you pick 10 stocks or whatever it might be, so I'm pretty sure they're so cheap or has stuff going for them that I think they're probably going to do 100% over 2 years. 2 years worth of news releases, 2 years worth of uh, management alpha, for example, 2 years or whatever. Because it's hard to bet on the gold price and silver price, of course, and that's why I call my approach kind of the all-weather approach. I'm more focused on the specific companies, or more focused. I'm only focused on the specific companies and what their assets are worth and what they could be worth. But if you were to do that, I think that a compound rate of 41.2, or if it's 42.1 or something, regardless. So I use 41% per year, which is obviously too low for anybody to give a shit. Yes, I know. Over 15 years, that's 17,209%, and $10,000 would become $1.73 million over 15 years. And you can imagine, add on 10 years, on top of that, and lower it to 20% or whatever you might want to do. If you could just, I mean, almost regardless what you start off with, assuming you're not gonna, die tomorrow, for example, knock on wood. Uh, uh, there's no way you're not gonna have a big portfolio. But if you want to get rich overnight very quickly, which is probably 95% of all active investors, you're gonna just be trying to go for the hockey stick charts, and you're just looking for cases that could go up a lot in the short term, and most of them are cases where they will probably not go up a lot in the short term, and there's much higher probability that they're gonna go down a lot in the short term. So in theory, if you could bang in 10 discoveries out of 10, yes, your portfolio might go up 500% in a year. More realistically, you might get 1 out of 10 that actually make a discovery, if we're talking pre-discovery, or 2 out of 10, and you're going to lose on 90 to 80% of those cases, and all of a sudden the actual portfolio returns go down quite a bit, because you took a 50% loss on 70 to 80% of your portfolio. So even if the other two do indeed go up 500%, it's not like you're gonna 5x the portfolio that year. But that's an obvious mistake. I mean, that's the thing. It's like, in my opinion, if you're, let's say, strong enough to be bored and actually be greedy about probable doublers, for example, over 2 years, and that is very, very few on earth who can even possibly do that, you're probably going to have better returns than 98% of all active investors. But it's not sexy at all. 99% of days you don't really do anything except watch paint dry and letting the case play out. And 95% of the time your portfolio will not make new net all-time highs, so it's going to feel like you're going backwards or sideways. So basically you have to be prepared to look stupid 95% plus of days, You have to suffer corrections 30 to 50%, where it looks like you're actually going broke instead of actually compounding at 41%. On average, you also have to be right, of course, and preferably you would also be cool enough to buy the dips. So yeah, I mean, okay, so think what a 41% per year could do, and let's just look at. I showed this before, and this is not a complete list or anything like that, and I'm not saying these are the best cases and yada yada yada, and some of the numbers are outdated, but it's like, I mean, I've used quite a few, economic studies or tried to guess some stuff. When it comes to what their project might do and when it might be in operation and what the ASIC might be. I think increased ASIC then a bit higher, especially if it's a PA. And then, I mean, kind of have a ballpark figure. I mean, take Amex. So they're PA. So I mean, they have doing bulk samples or going towards bulk samples and stuff. But let's say within 3 years, they would have an operation up and running that, according to the PA, would produce 102,000 ounces per year at an ASIC of 1165, and you could increase that, of course, to be a bit more conservative, whatever. Well, then if we just assume a 6-time ASIC valuation, well, that's $3 billion at $4,900 gold. And if you assume dilution, I used 25% dilution, you're looking at a 292% return over 3 years. That's 58% per year. That's better than this. And that's not factoring in any exploration success. And of course, I mean, Amex might very well get acquired before that. And actually, let's look at, I mean, how ridiculous, again, the projects are at these gold prices. So here's their economic analysis, PEA, so it's probably a bit optimistic still. Here's their base case, $2,500 gold. So their base case is if gold dropped 50% from here, and basically, I mean, if you count from 5,600 down to 2,500, that's more than the bear market in terms of price decline for gold that happened 2011 to 2015, which was one of the most brutal bear markets in a long time. At that point, the payback period would still be pre-tax 1.1 years, post-tax 1.4 years, post-tax IRR of 70.1%, post-tax NPV to capex of 7. I mean, it's ridiculous. And spot, and of course this is already outdated, spot is 5,000. There's a bigger jump from here to spot than from the base case to spot, which is, I mean, supposed to be the upside. And that's why also I think that this kind of stuff, I think, sends this signal that this gold price is too high, right? And I discussed this with Chad, where when years ago it's like, oh, we can't use a higher gold price or whatever, we have to use spot, that's the only thing. And nowadays, where it's like gold price has gone up so low, such a big amount, but still it's like nobody's comfortable using spot. So base case, this is like, should be called bear market bottom scenario today. And then it has still a post-tax IRR of 70 goddamn percent. Spot post-tax payback period is down to 0.4 years. And if you add $1,600 more in gold, I don't know what the post-tax Well, here we actually have 4,000. Then it's down to zero point 0.2 years. IRR of 130%. Post-tax NPV of 2,340. And that's still $1,000 away from spot gold price. That's the most relevant gold price we have, which is what the gold price is right now. And I don't know what the ratio to post-tax NPV would be, but 20. I mean, it's just absurd. And what's the market cap? 617. It's like this is probably not too far off from what they would make in a year. No, it's crazy. I mean, if somebody offered you, or it's like, hey, you want to buy this project? It costs whatever. I don't remember what the initial capital is. Yeah, okay, 146. Yeah, 146, and you're going to be earning, I don't know, 400 per year, and we get like 2.6 million ounces plus an entire land package. Does that beat the bank savings rate? Yeah. No, it's just absurd. It's like I talked about this before, where Eldorado Gold bought Integra Gold at a premium to the spot NPV. So imagine what the spot NPV would be for Amex right now, and they paid a premium to that. How many multiples of the current market cap is that? So like at face value, we still have a margin of safety even if gold went into a full-blown bear market right now. Yes, account for the fact that time, value, money, etc. But it's just crazy. I mean, how much margin of safety should there actually be? I mean, at what other point in modern history would you look at a gold developer or advanced explorer, etc., and see this amount of margin of safety? And then it's like, yeah, well, Amex is up 330% in a year, and you're like, yeah, well, it's already run, so I know what happens after these sector rallies. But it's like, yeah, we've never seen that after a run like this, it's almost as cheap as it was before the run even happened. So my point is like, people selling out of these juniors because there's always a seller and buyer, right? And today 185,000 shares were traded. Of course, there could be somebody found something even cheaper, or kind of try to balance the exposure, meaning okay, I'm gonna reduce the position size a bit. That's fair enough. But other than that, it's like, what's the reason for selling some of these gold and silver juniors? It sure as shit isn't that you can point and claim that, well, I'm selling because this is overvalued. Oh, it should go down. That's the thing. Now in 2016, GDX was probably overvalued. It should go down. And then gold went down, and this already should go down. I mean, the juniors, think about this. Okay, why did I don't have a junior chart up now, but let's look at SILJ, for example. Might be more relevant to like how the juniors might have moved. Yeah, so let's look at this move here. Minus 66%. Okay. Let's say juniors went up there. Silver and gold prices were there. So they're pricing in a premium basically. And we know how leverage works, right? And the lower the margin is, the higher the leverage. I mean, if you took away $10 from $80 silver, and the margin was like uh, 40, or the costs were 40, you went from $40 in margin down to $30, and then another $10 drop obviously reduces the margin even more. So the lower the prices or the lower the metals are, the higher the leverage both up and down. So you went from overvalued pricing in this kind of silver price, then silver prices went down, and then sentiment switched from uh, premium to discount, and all of a sudden you have a 66% drop. Makes total sense if you include metal price movement and sentiment swing. It went too high, then the metals went lower, and it went too low, and you have something cut in 2/3, which is kind of common in this sector. So there was no margin of safety here. Now it's more like, let's say this here should be up there. So instead of trading with a premium, it's actually trading at a discount. So even if silver went down here, whatever, okay, that's some kind of a drop for sure. Not a big. I mean, if the value went down here, then it's just whatever, some percent overvalue. But the thing is, more importantly, I think, why I'm so bored right now, is that even if you had, if you had juniors pricing in this, and the metal price was here, let's say they were pricing in $100 gold, and now we know that because that's a fact, gold is 5,000. $5,000 gold. What happened? Actually, we should have the gold chart up instead. So let's say the juniors are pricing in a gold price of 2,500. Just to make a point. I mean, this is just what makes it ridiculous. And again, okay, if that's bullshit, it's like we can look here. This is a PA. Post-tax NPV $2,500 gold, 1,085,000,000. This is obviously not at 1,085,000,000. This has whatever 80% upside to go to price in NPV of the project according to the PA. But let's say, okay, with some conservatism, etc. Let's say this is actually pricing in $2,500 gold for the Perron project. So this is the margin of safety. Unless gold goes below this, our investment is cheap. That's a lot of margin of safety. That's a lot of gold price to be free rolling. But wouldn't you have it, disaster strikes and actually gold goes down to 2,400? From the top, that's around a 57% fall. That's a proper bear market. Worse bear market than 2011 to 2015. Oh shit, okay. All of a sudden, we overpaid today by, and this is not accounting for leverage, but 5%. So let's say we overpaid by 10%. So at face value, it's like, okay, well that's not really a big problem. It's like it's 10% overvalued, let's say. If a full-blown bear market in gold happens, and we're not counting inflation, deflation, yada yada yada. Well, okay, if that happens, like that's a pretty good. It's like, oh, worst case scenario happens, we go into a full-blown bear market from here, and gold is going to go to $2,400. But you paid such a cheap price, such a cheap price, that you barely even overpaid. It's like, and at face value, the share price shouldn't really move much. You should just lose 10%, which is obviously not a lot of, not a big thing after having the kind of run we've had in the juniors. Even, I mean, if you lost whatever 10% and you bought Amex, whatever, 2 years ago, you're up 300%, you lost 10%. So what? I mean, that's a proper, even if it went down 10% over the next 2 years, I mean, if you, on a 5-year period, 300% is great. So it's like, at face value, we're basically as secure as you can be. And then, of course, yes, theoretically, it would be overvalued if price of the company stayed the same. So gold price drops to 2,500, 2,400, I should say. Amex drops 10% during that period in time. Or even if it doesn't drop, it should drop 10%. But the price of the shares didn't move. So you sell because all of a sudden, yes, you are actually trading at a 10% premium, so it's overvalued. Fine, that's a legitimate reason, obviously legitimate reason to sell. There's no margin of safety. You're paying a 10% speculative premium. It's pricing in that gold is 2,500, where gold is now 2,400. But what do you think? Do you think the juniors are just going to absolutely stand still? No, let's say the value went down here. But the price of, let's say Amex dropped 50%. So in that scenario, the post-tax MPV would still be 1,000 or a bit lower, I guess. Let's say $1 billion. And let's cut off 50% from Amex. And they have some cash also. So let's say the enterprise value goes down to, I don't know, how much cash do they have? Let's say 280 million CAD enterprise value. Okay, 280 million CAD. Well, the MPV at $2,400 is around 1 billion. So you're looking at more than 300% upside. And by that time, gold would be down 57%. And that's like, again, already a bigger bear market in 2011 to 2015. And sure, it could go even lower. I mean, if we're like proper super bear market, like one for the ages, like 1980 to 2000. Yes, then there could be even more downside. But I would argue that that's not very realistic. I mean, it might happen, but gold might do a decline like that after it's up to $20,000 or something. But let's say a more realistic worst case scenario where gold drops to 2,400 and Amex drops by 50% from these levels. Then it's still a 4xer on paper. And of course, by that time, let's say it takes 2 years for that to happen, for gold to, gradually decline its way back to 2,400. But that point, Amex might be close to production, and where this value here, let's say, is very, very real. And all of a sudden, it's more de-risked, it's more advanced. They're actually going to be cash flowing, and they would be cash flowing at $2,400 gold. You're gonna, it's gonna bounce from that level. And actually, on paper, it should go up more than 300%. So in no point in this exercise would your buy/hold today become a sell. Right? It's too cheap today, let's say, so it makes no sense selling these high quality gold developers that are pricing in $2,500 gold. If gold went to 2,500, they would be pricing in, I don't know, $1,700 gold. And if they drop by 50%, they might be pricing in even less than that, and they would still be absolutely no-brainer cheap. And at that point in time, if gold is down 57%, you can bet your ass that the next 50% move or the next big move is going to be to the upside again. So then all of a sudden you find yourself in something cheap at the start of or close to the end of the next bear market and the start of the next bull market, and usually juniors go up 300%, etc. And if it's trading at 75% undervaluation with gold at 2,400, and then a typical bull market has whatever, gold goes up to 6,000 or whatever it might be. And at that point, Amex might be worth, I don't know, $4 billion, and down here at the lows it was trading at 280 million EV. But I mean, again, if they actually went into production around that time, there would be some dilution, etc., etc. So this is, I mean, quite hypothetical, but I hope you get my point. So it's like, it's so easy in a sense. It's boring. It's like, could something happen? Could we have a nuclear war? Yes. Could we have, I don't know, AI solves everything, and we can make gold or whatever from sand or iron? Yeah, everything is theoretical, but or anything could happen, but then it doesn't, I was going to say, then it doesn't really matter, because then we're going to have, I don't know how the world is going to look, but our portfolios is probably not going to be a big problem, if you know what I mean. We're going to have way bigger problem, or we're going to be living in an absolute utopia, and then it doesn't matter either, really. So, I mean, that makes things very easy. Boringly so, because there's no like obvious credible scenario anytime soon where I have to think about selling, except if they go up and I make money. If they go down first and we have a proper bear market, then they would go from buys to buys, so there would be no point in selling at any point in time unless gold went to 2,400 and the juniors didn't go down in price. Then I have the luxury problem of selling because it's overvalued without actually losing anything, or let's say I lose 10%. That's the only scenario in that case where it's like, oh, a 10% paper loss, that's my bear case. And the other one being like it actually did go into a bear market, but everything got cut in half. So now they're absolutely no-brainer cheap, and now gold has gone down 50%. So now the next obvious move is going to be that it goes up whatever 26 and then 88 and 265, and it's like, okay, well, great. Then I'm going to make a whatever 10 bagger, 20 bagger from those levels. I hope this makes sense. I mean, in my opinion, everybody says, or everybody, but keeping it simple. I think it's harder to keep it more simple than this. We're past the point of selling. It's like I don't see any really credible scenario where all of a sudden what I own, I'm gonna have a loss and they are turning into sales. If they show a loss, they're going to be no-brainer buys, and I would be an absolute idiot to sell them, because I'm going to make 300-400% from that level. So they need to drop 70% or something from these levels for that to for me needing a 300% in that case. But if some of these drop 300%, what gold price would they be pricing in at that point? How low does the gold price has to be for Peron to show a NPV of, I don't know, 170 million? It shows 1 billion at 2.5 thousand dollar gold. Let's say gold needs to go to, I don't know, 1,600. And again, if that happens, the next move is probably going to be absolutely gigantic to the upside, because that would be the, yeah, one of the most ridiculous bear markets ever. And last time a drop happened like that, okay, all of a sudden has it freezed? Okay, I hate this. Anyway, gold went, I don't know, I remember what it bottomed in that year 2000, but then it went on to an 11-year bull market. Yeah, it would be delayed gratification, but from that point, you were looking at an 11-year bull market in this kind of worst case uh, scenario. Anyway, so yeah, I mean, it's just, yeah, it's like, in my opinion, shooting fish in a barrel. I didn't see this. It's weird to say. It's like most of the stuff is up and is still cheaper than it was during the 2015 bottom. If you just look at price to MPVs and you account for quality in terms of margin of safety with like how high are the IRRs, which is AK risk basically, payback period, yeah, margin of safety in absolute terms and relative terms, and it's not even close to anything I think anybody's seen in 40 years. So that's a pretty good, point to be in, where it's like, yeah, the portfolio's done well, but hey, on paper it's like having almost a bull market left in the tank after we've already had a nice rally. And I've never seen that before. Again, 2016, they got overvalued. They should not go higher unless metal prices went higher. No margin of safety. 2020, maybe not even any margin of safety there. And to this point, it's like, what happened when? Okay, it's actually investing site that's gone down. Anyway, I mean, what happened during the crash last Friday or 2 Fridays ago? Worst metal crash in all of history, at least for silver, I think, in a day. So if you would think that's like, oh, the juniors are gonna be, if silver's down 34%, 35, the juniors are gonna be down 70% or something. BlackRock silver ended down 4%. That's the beauty of margin of safety. You can't really touch it in a sense. No, nobody knew for sure. But if you were like me, fully invested, because everything is so goddamn cheap that it's not even pricing in anywhere close to 1100 or $110 silver or $5,600 gold, then boom, worst case scenario happens, the worst metal crash in a day in history, and your portfolio is down 6%. Isn't that the beauty? It's like, oh shit. I mean, imagine somebody told you, it's like, hey, just so you know, your portfolio is so cheap that if the worst metals day in history happens, you're going to be down 6%. Or I think the hodler folders were down like 4.2 to 5.5. That has happened plenty of times before. It's like, okay, that's great. I'm taking all this upside, and if the worst daily scenario that's ever happened happens, I lose 5% of the paper value, and they would still be cheap after that, even though they didn't really go down in price. It's absolutely remarkable. If somebody told you, it's like, how much are you will it's like, I can save you from the worst metals price crash in history. I can sell your portfolio right now at the market the day before it happens. What's my fee? How much would you be prepared to sell your portfolio for? How much of a discount just to be out of the worst metals crash on a daily basis in history, when silver went down 35% in one day? Whatever you would pay, it would probably be, you would probably have lost money. I mean, if you're like, oh, hey, if that crash happens, there's going to be pandemonium out there. Stuff might be down 30, 40, 50%. So I'm going to pay, you can take 15% of my portfolio if I just miss that day. And let's say, the portfolio actually went down like, I don't know. I mean, depends on obviously how diversified you are and whatever, but let's say it went down like 6%. Yeah, so it's like, okay, I'm gonna take a 10 to 15% haircut because I think it's actually could go down 20, 30, 40%, and then it ended up going down 6%. So in hindsight, uh, that looks like a pretty good portfolio. And what does that suggest? Well, that the hot money is not really in yet. I mean, it's almost like there's so few in, at least such a low amount of dumb money, that there's not enough people to actually panic sell the stuff, even with a metals crash like that. So, which goes to my point that I still think it's almost like we are indeed climbing a wall of worry, and the juniors are indeed pricing well at cheapness levels, which you would see in preparation, near the bottom and ready for the next bull. And I've just played around with some, chat GTP here, uh, I think the gold price was around $5,000, and just looked at it, Amex, BlackRock, Viable Gold. What's their MPV? This is projected because most of them don't have like $5,000 gold in their economic studies. But the MPV of their projects at today's gold price, and I'm not saying this is even correct, but I did it for fun. Well, anyway, 2.3 billion, 2 billion BlackRock Silver, Revival, 1.8 billion for their Mercury project, 1.1 billion for their Bear Trek Arnett project, for a combined almost 3 billion. Okay, discounted that, I think it assumes like, okay, discounted at 5%, and you assume that it's going to be 3 years for the projects to actually get into production. So what's the MPV then? Well, it's like 2 billion, 1.76, 1.6, or a total of 2.5. What's the initial capex of these projects? And I don't know if all of these are right, but I wouldn't be surprised. These are, pretty much low cap. I mean, super high grade, and all that. So it's like 100, 178, 208, 114. Net asset value divided by capex, 18. And that lines up with what I said, that it might be 20 for Amex. Insane efficiency in a sense. 10 times almost for BlackRock Silver, 7.66, 8.48. I mean, look at some of these big copper projects out there. It's spot copper prices, and copper prices are around all-time highs. But it's like usually you see probably like, I don't know, 3 billion NPV at spot copper, capex 1.2 billion, IRR 25, and I didn't include IRR, but it's just obscene how high. It's like blue sky is already happening gold, but there's nobody listening, kind of. And then you look at the market cap, NAV times market cap at spot gold, 4.4, 4.5 almost, theoretical upside, 4.3, 10, 6, combined 16. And then I just had fun, looking at, cheapness, more of a cheapness ratio, where it's like NAV divided by market cap divided by the capex. But this was, does this even make sense? No, market cap, yeah, higher, better. Capex, yeah, lower the high, yeah. Might make sense, but obviously it's when the ratio kind of goes bananas. Anyway, I rest my case. But this isn't even correct. I mean, okay, so I'm assuming they must, yeah, okay, US dollars. And so this is probably US dollars as well then. But that doesn't matter as long as the market cap is the same. But like, if you were any value investor, and it's like at face value, okay, Amex is worth whatever this is in CAD today, or let's say discounted. Let's say it's $2.5 billion, and the market cap is 600 million or something. That's not, you don't need to be a rocket scientist to see that that's cheap. Also one that I've actually looked a bit, like B2 Gold. So I don't really touch the large producers, etc., etc. But it's like, okay, B2 gold looks actually very cheap. And they've had problems. I think they had some political problems in Africa, and then also their goose project in Canada. So it's always, there's no such thing as guaranteed. It's always a risk reward. But their guidance for 2025, which is obviously already over, but around, let's say, 1 million ounces of production a year, or they produced around 1 million ounces. So let's say that's the quote steady state. I don't think they've given a guidance for 2026, but I assume goose is going to be ramped up. ASIC around, let's say, $1,500. So I just played with ideas like, okay, show me the EBITDA, free cash flow, net income, EV/EBITDA multiple, free cash flow yield, and PE, assuming gold prices are $4,952 dollars per ounce over the next 5 years. And here they have a production profile, which is, I don't know actually if this is that true, because if you also look at the presentation here, it's like organic production pipeline. Potential to bring over 750,000 ounces of new annual production within the next 5 years. So they produced around 1 million ounces in 2025, and they have the potential to almost double that over the next 5 years. And this is obviously not going up to anywhere close. I mean, this is actually dropping off. So this might be totally wrong, but regardless, I mean, it's like P of 4.9, and it's like 3.4, 3.6, 3.7, 3.7 free cash flow yield, so like 27%, 26%. And that's without any of this happening, really. And of course, sure, things could go bad as well. But if they don't go bad, let's say they don't lose a mine or anything like that, and they're actually able to, whatever, get half of this new production up and running within 5 years, I mean, then this is going to be even higher, maybe 35% free cash flow yield, PE of, I don't know, 2.6. I mean, that's just absolutely ridiculous. Then imagine if gold prices keep going. This is just, I mean, crazy. I never thought I would actually buy a gold major, but they've been kind of lagging. And who knows, maybe there's some fund that needs selling and they get spooked by whatever, some headlines, or goose taking too long of a time, or yada yada, momentum players like, oh, there's not much momentum in B2 gold. It's like, do I know that B2 is going to go up 3 times or whatever in the next 2 years? So no, I don't, but it's like, if I just stack my portfolio with a bunch of like stuff that's selling for probably, I mean, you could easily see how they, again, going back to this is what a double over 2 years does. A lot of these, I mean, the high quality developers, especially if they're getting closer to production and this discounted NAV, which then turns into today's NPV. I mean, if they are, let's say, in production in 3 years, so, and gold prices are the same, this is what they should maybe be worth, and this is what they're actually trading at. So yeah, I mean, I don't think it's gonna be. It doesn't look like just a remote possibility that you can make a pretty good portfolio that over the next 2 years, 100% return, which over the long run would create this, to put together something like this. And then, I mean, pick 20 of these, pick 30 of these, whatever. I mean, a lot of these have like built-in 3 to 4xers maybe, unless if they don't get acquired before, and stuff can happen. But again, if you have some that you think, hey, this could actually do, whatever, 300% in 2 years instead of 100%, then you can obviously afford to be wrong more and still get 100% per year, which still would compound at 41% per year, and have $10,000 become $1.73 million over 15 years. Maybe we're going to be compounding at 60% over the next 2 years. I have no idea. I would not be surprised if some stuff I own went up 100, 200% this year because they're so goddamn cheap. I mean, I think I can easily see how Gold Sky goes up 100%, and that's in 1 year, not over 2 years. Then the compound rate would be 100% for that play at least. And yeah, it would just blow whatever this out of the water if you could keep doing that, of course. Maybe I'm up to such a long time already in terms of ranting that I might as well cut this off now. But yeah, I mean, I don't know what the closing thoughts would be except that, I don't know. I mean, yeah, I mean, I think the price to value gap is so large out there that it's kind of like, if gold doesn't go into a full-blown bear market, we're going to have another bull market in the junior space. And if gold actually does go into a full-blown bear market, we paid such a low price that it shouldn't really go down, except if gold goes down 250 or to $2,500 or something. And if it does and the juniors go down 50% or something more, well, what happens after that is that we're going to have a gold bull market again, and they're going to start at whatever levels that are pricing in maybe $1,700 gold, and all of a sudden gold again goes to 3,000, and they go up 5x after gone down 50%. So it's like I don't really see a problem. That makes me very, it's like I don't give a shit what there's gonna be. I mean, there's calls every single day. It's like last week I think we had a very red day, and it felt like sentiment was kind of getting kind of bearish, and of course everybody that's trying to predict short-term stuff, which is almost everyone, they're out there guessing what's going to happen, and you see headlines, yada yada, and you see some bashing from the media, etc. It's like noise every day, all day, noise, noise, noise. But if you just look at price to value, it's not even a debate. Some of these juniors are as cheap as they've ever been. There is no debate if you're a value investor. You would be dreaming and drooling about being able to own these stocks at these prices, at these gold prices. So it's pretty much boring. It's like 2024 all over again, where it was just so goddamn boring because the next big move in the juniors are gonna be up, and it's just a matter of patience. And when the last person has sold that thinks that this time is different, it's never gonna go up, we're gonna go up, and lo and behold, that happened. Boringly predictable. And now everything is still so cheap that it's like not even close to having to make a whatever, some thrill where it's like, ooh, am I really overpaying for this? Where's gold gonna go? And yada yada yada. There's such cheapness out there that it's like you don't even need. I don't know how many you need to actually be right on. It's like you don't even need to take expiration risk really, to be honest. And that's why I'm still, not super weighted in expiration stocks, which I typically am, and I mean been most of the last 10 years. But for the first time since 2023, 2024, I could not ignore the fact that bank success was selling below sunk costs at the time. Amex sold for when I picked that up at, I don't know what the market cap was, 110 million. I think they spent 100 million. So it's like, how crazy is that? Takes 7 years. You find one of the highest grade deposits in Canada, in a good area of Canada, in Quebec. It took you 7 years and 100 million, and I could buy everything after the fact for 110 million. I mean, it's jaw-dropping stuff. It's like, who wants to actually leave this sector? I mean, is there any sector that is that behaves like this? What am I gonna be out there like? Oh, Apple is selling for 25 times earnings. Or I think it's worth 30. Or I think it's gonna whatever. I'm gonna beat a million analysts, and it's like, hey, I think Apple could actually surprise with the next iPhone sales, and it's actually trading for a P of 22 in a year from now or something. So I think I have my 15% edge there. Whereas like here, it's more like, oh shit, I mean, the no-brainers are so unreal that you don't even. I mean, everything you were taught in university about efficient markets is like, yeah, that textbook you can throw that right out the window. This is the wild wild west, and anybody, in my opinion, with a huge amount of patience, common sense, you're gonna make you probably could make money forever. Not every month, not every year, even. Um, but yeah, I mean, how often should you be? I mean, you could wait 10 years to see stuff like this, and you should probably be happy. And just keep in mind that the stock market averages around 9% per year over the very long term, and most people underperform an index. So yeah, no, it's just unreal. It's boringly so. It's like today I was thinking, it's like maybe I should have a 6 month vacation or something, because yeah, there's not too much to think about. It's just such an insane amount of absolute no-brainers that is like they're so cheap that, again, you don't even need to have a high batting rate, let's say, to make sense. I mean, so what if uh, not all of these are true? Let's say one of them fails or whatever. You end up losing on it. Well, let's say 2 out of 3 actually are in the ballpark, and it should go up 200-300% over the next couple of years, and you lost. One went bankrupt. I mean, that doesn't even happen often unless you're in production. But let's say that happened. Well, 2 out of the 3 threw off to 300%, and you lost 100% on 1/3 of the portfolio. I mean, that's still going to be a great, average return over 2 years. Even if, I don't know, if you have two go bankrupt out of 3, and one makes it and goes up to just 200%, then you're even. And that might be, you're even if you're unlucky, in a sense that where it's like, yeah, balance of probability suggests you should be making money on 2 or 3 out of 3, or like 2.5 out of 3. You end up losing out on 2 out of 3, but the one that made it paid for the other two, and that might not even be blue sky. So it's like, yeah, I mean, uh, this sector is absolutely ridiculous to the point of boring. Anyway, that's it. Consider me biased. If I talked about uh, any companies, consider I'm biased. I own them, or I might own them. I don't know. I don't remember which I talked about. I might buy or sell at any point in time. Do your own due diligence. Never buy a case you don't understand. Never invest money you cannot afford to lose. For example, I sold some Gold Sky today, for example, because now I looked how big the position is. It's crazy high. I need some money for a private play. I might sell up to, I don't know, 2 to 5% if I had to guess of the portfolio. Maybe, but it's by far the largest one in my public portfolio. I think that's gonna, yeah. I mean, I might be wrong, but I think it's probably gonna go up at least 100% this year. That's why I love it. But it's also to the point where it's like, after the run up, that it's beyond the nosebleed levels in terms of concentration basically. Um, and yeah, a private play popped up, and I don't have any cash. Um, so yeah, just a reminder where it's like, uh, I mean, again, make your own decision. Assume I might buy or sell at any point in time. I'm not going to be holding anyone's hand, etc. Unless you, if you don't have conviction, there's no point in buying anything really. Because if you know exactly why you think something is cheap, and you know kind of what you think the news releases are going to be over the next 2 years, and you see a 5 or 10% dip, you're going to be licking your chops. If you have no idea, you're going to be terrified and probably sell out and buy something that's up 10% instead, and then that's going to go down the next day, and you're going to be stuck in the cycle of selling low, buying high, because you have no idea what the value is and what the price is. Anyway, thanks for listening. Bye bye.